Hi, everyone. Thank you so much for joining us for today's free webinar, Alternative Startup Financing Options with Branden Harper from Lighter Capital and Sirk Roh from Early Growth Financial Services. My name is Erica Malsberg, and I'm the Chief Marketing Officer for Early Growth Financial Services, and I'm going to be your moderator today. This presentation is going to run about 40 minutes. If you have any questions as we go along, please feel free to enter them right into the question chat field, or you can also tweet them to us at earlygrowthfs with the hashtag alternative funding. Don't just raise your hand if you have something to say, just jump right in so that we can try and address them. If we run out of time, we'll follow up with you as it makes sense after the course of the presentation. We'll also be sending out a follow-up email tomorrow that's going to have a link to this deck and the recording, so you'll have that for your reference. So I want to start by introducing our presenters. First, we're very pleased to have with us today Branden Harper, Director of Lighter Capital. Branden has 10 plus years experience financing early stage tech companies, either as an entrepreneur or as an investor, and he's raised or invested over $50 million. He was a senior partner at GT Securities, where he focused on emerging technology companies, capital raising, and M&A. He's held various business development, finance, and client management roles at venture and angel-backed digital media, mobile, and music technology companies, and as an angel investor. He's invested in various music technology companies as well. He holds his MBA from University of Washington and a BA from University of Texas. So good afternoon and welcome to you, Branden.
Thank you very much. It's a pleasure to be here.
Great. And also with us today we have Sirk Roh, who's Chief Operating Officer with Early Growth Financial Services. Sirk has 25 plus years of finance experience, with 17 years serving in financial leadership roles with high-tech companies. He's an accomplished finance executive focused on leading early-stage companies through strategic financial decisions. So good afternoon and welcome to you, Sirk.
Thanks, Erica. Pleasure to be here.
Great. So before we jump right into the content here, Branden, do you want to go ahead and tell our listeners just a little bit about Lighter Capital?
Sure. Lighter Capital is an alternative growth capital finance firm headquartered here in Seattle, Washington. We provide growth capital to fast-growing technology companies in the form of revenue-based financing, and that means that the instrument itself is through debt, and it's a royalty that's affixed to your recurring revenues on a monthly basis, and the upsides are that it's non-diluted growth capital for companies, and to date we considered one of the more active revenue-based financing companies in the country for technology companies, with over 80 financings to date.
Great. Thank you so much, Branden. And of course, we'll be talking a lot more about revenue-based financing as we discuss all the different alternative financing arrangements as we go through this presentation. Sir, can you also just say a few words about Early Growth Financial Services?
Yeah, absolutely. Thanks, Erica. Early Growth Financial Services is an outsourced financial and accounting services firm. And as our name suggests, we work with early stage companies, many tech startups here in the Bay Area, but across the country. We have 400 plus clients across the country. We have offices here in the Bay Area, down in Los Angeles as well, and offices also in New York, Chicago, Austin, Texas, Boulder, Colorado, and Seattle, Washington. And we basically provide 4 types of services. We do corporate tax returns on an annual basis. We also do 409A valuations, so for companies that are providing stock options to their employees, that should be done on at least an annual basis, and we provide that service. And then finally, we provide consulting level services at both the transactional or bookkeeping/accounting level, as well as CFO level services. And usually we go in as a team of 2, a senior accountant and a CFO, and what the client gets is a dedicated team that is leveraged properly, where the right level person is doing the right level work, and we're doing it on a very, very cost-effective basis, providing lots of expertise, but providing it at a value that makes sense for early stage companies prior to that having to hire people internally.
Great, thanks so much. Okay, so let's just go ahead and jump right in.
Fantastic. So, so this is the stuff we're going to be covering today. We're going to talk obviously about fundraising, right? And we're going to talk about some of the different things that we want to be looking at. And as the second bullet point points out, it's not just about the money. Yes, you're trying to bring in money, but you want to think about how you're doing it, what the different trade-offs are for different types of financing that you're going to be doing. We're going to look at kind of where the company's at and what you're looking to do. What kind of company? What kind of revenue stream do you have? What kind of growth are you looking at? What kind of milestones are you trying to hit? Those are all going to have a big impact in terms of the types of fundraising that makes most sense for you at this point in time. Obviously, early stage companies all have a different profile than a later stage company in terms of attraction, in terms of the team that you have, in terms of product development and revenue. So all those things are going to have a pretty big impact. One of the things that obviously that is near and dear to your heart is looking at the equity versus the debt considerations, right? There's positives and negatives to both. Just like as in anything else, there are going to be trade-offs, and understanding what those trade-offs are, and understanding where it makes most sense for you. And in most cases, you're going to be doing some of both throughout the life of your company. So understanding when you want to look at different types of considerations, you're going to be doing that. And then finally, we'll just touch upon kind of some of the things that you need to be doing as a company in preparation for investment capital, either from lending sources such as lighter capital, or from banks, or from equity investors such as angel investors or VCs. Branden, did you want to touch upon any of that?
No, we're all set. I mean, I think it's pretty clear. As you mentioned, it's money or the capital that you're looking is one component, but there's certainly a lot of steps to get there and a lot of considerations. So I think we'll make sure to cover all that.
Fantastic. So this is kind of a game plan, right? And these are some of the questions that we need to be asking ourselves, as we go to a round of financing. And it's how much money do you need to raise? And if you don't know that, if you're just kind of playing it by ear, that's really not the right way to do it. You need to figure out what you're trying to do with it, the uses of the cash that you're going to be getting, and what you're going to be achieving with that, because there has to be a game plan. So no one's just going to give you money just to give you money in hopes that you're going to be successful. There has to be a game plan. Obviously, you want to look at what the cost of that money is, right? There is a cost. There's a cost across the board, no matter what. Whether you're paying interest on a loan, whether you're giving up some of your revenue, the way that Lighter does it, or whether you're giving up equity. And when you give up equity, you're not only giving up equity in the company, but you're probably also giving us some control in terms of direction. You're going to get a lot more people with opinions, strong opinions in the cases of VCs, where they're going to be really driving some of the way that you're going about business. So those are things that you need to keep into consideration. And obviously, for us at Early Growth, and I'll certainly let Branden speak to this too, that this last bullet point is to us kind of the biggest thing, right? And we talk about milestone financing, and we talk about, okay, as you go through the life of your company, and as you go through different stages, as you get past the seed, through a Series A, through a Series B, through a Series C, and then some of the debt considerations along the way, basically what you're trying to do is you're trying to figure out for every single financing round that we're doing, what are the milestones I'm trying to achieve? Because it's those milestones and achievement of those milestones that's going to drive the value creation of your company, right? So if you take a look at the valuation of the company, it's not linear and it's not a curve, right? You're going to have these hopefully nice step function increases in valuation. And those step function increases in valuation happen when you hit big milestones. And so think about, okay, what are the milestones that I need to achieve with this next round of financing, whether it's product development, customer acquisition, revenue traction, whatever it may be, and really put that down as the milestones you're trying to hit. And if you hit those milestones, then what you've done is you've set yourself up so that you're in a good position to not only raise the next round of financing, but on the terms that make the most sense to you and allow you to keep as much equity in the company as you can.
Certainly, and Sirk, I mean, I would say that to just reiterate here, and what we see quite a bit here at Lighter Capital with all the different companies that we evaluate for investment, I would say that the best entrepreneurs that we work with definitely have all these questions answered before we engage with them. It's definitely good to understand what their game plan is and the use of capital. And it's always, what we find also are are the uses of capital can be, as you mentioned for Milestones, key themes that we see quite a bit are key. They might need additional salespeople to hit certain revenue targets. It might be to finish, put the finishing touches on a new product and get ready for product launch, so they understand the cost drivers and the exact dollar amount to get to that point. It's just really makes a big difference, and it speaks well for the better management teams that go through the internal exercise and preparation to be able to reference these numbers and the underlying assumptions that go behind it. I think it's safe to say that those are the kinds of companies that get funded across the board, and we seek to work with those companies at large.
And the final point I'll make on this is that you gotta do everything that you can. Obviously, cash flow is king. You guys know that as entrepreneurs, but making sure that cash lasts to the point where you're able to hit those milestones. Because hey, let's face it, not everything is going to go according to plan, right? There's going to be slippages. There may be some pivots in your model, whether it's product development or customer acquisition strategies. There are going to be pivots. And the key is to make sure that the cash that you have is lasting you to the point where you're able to still hit those milestones even as you're making pivots. And to that point, looking at not only, okay, let's do a round of financing for equity, maybe do a Series A, but on top of that, what else can we do to maximize our potential and minimize the risk associated with kind of what we're doing as a startup, so that we can really hit all the milestones that we're trying to achieve. And obviously, other types of financings like debt, like revenue-based financing are key components of that.
Before we move on, we have our first question from the audience. Julie wants to follow up on this idea of milestone financing. She's asking, if you're seeking your first round of investment, are there certain kind of milestones that investors prefer to see? So I think, in other words, like, are there milestones that make them more likely to want to invest in your company?
Yeah, absolutely. I'd say, and kind of depending on the kind of company you are, but nowadays people are able to do so much more with just a little bit of capital, right? So they're going to want to see, an investment made by the founding team, both in terms of a little bit of capital as well as obviously a lot of sweat equity. They're going to want to see traction. I mean, there's no doubt. I mean, it's just, everything else being equal, traction, is king, right? If you have data that suggests that people are spending time on your website, or people are buying things, or you got a SaaS model that people are signing up for. Maybe it's a beta version, but people are actually signing up and using it. That obviously helps. Having a team, right? Having a right team, a management team that you can point to and say, hey, look, this is the team, this is the experience that we have, these are the successes that we've had in the past, this is why we're the right team to attack this market and be successful, is obviously very, very critical as well. And then obviously product development. The more you can get done with before you actually go out to raise financing from anyone, is going to probably be, in many cases, the difference between someone investing in you versus someone else investing in someone else that may have a similar strategy or a similar offering to you.
Great, thanks.
Brandon, do you have anything to add to that?
Certainly. To add to that, I would say that if you're super early stage, as it sounds like this question is framed around, from my experience, it seems that the framing of either the product or service that you're bringing to market and the value to the customer and how you position that is really critical, because that's what really will attract the right partner at that very early stage. It's really the big selling point. I mean, on top of everything that Sirk mentioned, I would say that just how well you can articulate that and what the opportunity looks like, I think, is really critical.
Thanks.
Great. So I'll take this one here. So on fundraising decision points, when as you're considering the types of ways to raise money and the types of structures or types of partners. This is more of an internal checklist. When you're thinking about raising equity, are you in the position to start valuing your company? Like, do you have a sense of valuation, how to back into a number and support it, and understanding the tolerance for what percentage you're willing to give up on in your company. So, I mean, as Sirk mentioned early on in the presentation, when you're considering equity, you are giving a percentage of the company, and tied to that is giving away a percentage of control or a portion of control in the company. Are you willing to bring on a long-term partner that will sit alongside with you and make those or be instructive in making those key strategic decisions on the direction of the company? You know, and there's also just the cultural alignment there, which we touch on here towards the end of the slide. But you have to think about when you bring on a long-term equity partner, what the impact is there. And also there's value add. So I would say that equity, when you're thinking about angel or VCs, there's a lot of value add here with regards to strategic introductions, rolling up their sleeves, and really bring a lot of just experience and background and the leverage of the firm as a whole into driving the growth of the company for you. If you're considering debt, some banks do require personal guarantees on lines of credits or term loans, so a lot of companies or entrepreneurs have had to leverage and put a lot of their personal assets on the line, a house or car, and what kind of stress level will that bring to not only your company but your life at home as well. Time frame, I think this is really critical with regards to once you decide to raise capital, what is the runway or what are the key dates before, and you want to make sure both financially that you can sustain a long fundraising timeline. If you're considering more traditional angel VC, it could take as much as 6 months before you have definitive agreements and funding. So just take that into account, and banks equally move rather at their own pace. So you just have to take into consideration what your timeline looks like, and if you're timing it around a particular product launch, or if you have a key hire in place that you need to get on board, what are some of the alternatives in order to get the right funding at the right time. Horizon, if you do bring on an equity partner, they're going to clearly want to have an exit from the investment, and what does that look like as far as how do they get the capital appreciation and exit, and what happens to the company after that? Is it bought, or is there an opportunity? If it's a large opportunity to go after a big addressable market, is there an IPO in the works? Or are you the type of entrepreneur that has a company that it's more of a long-term build and hold kind of strategy, where you look to build it and it eventually turns profitable, and there's enough cash there to sustain the business for the long term and be, I don't necessarily want to call it a lifestyle type business, but with something that's sustainable, where you don't have the outside pressures to either sell or do something in order to satisfy the shareholders, if you will. And last, back to this concept of culture, wherever your partners are when you're bringing in funds into the company, you want to think about their impact on the culture of the company, and how they understand your needs and the vision of the company, is their alignment there. And I think it's often overlooked, and from my personal experience in financing companies, it's turned out that at times perhaps like the more expensive cost of capital from an equity perspective, like the more expensive deal terms that were taken on by a client of mine were taken over others, just because there was that cultural alignment, that they got each other, and there was a comfort level there, that they understood the business, they came from the same backgrounds, et cetera. So there are just a lot of different ways to measure culture, I would say. It's good to have a good sense of what you stand for and what the types of financing partners you'd like to bring on board.
Yeah, I agree 100%. The culture thing, I've seen it many times, right, where a team of entrepreneurs are working with investors, and they got a good deal from investors. They took it, and even from day one or pretty close after day one, there were clashes, right? There were clashes in terms of the direction of the company. There were clashes in terms of what was being reported, how was it being reported, how much input is the board or the investors giving to the company, and whether that was wanted or not wanted. So getting all that stuff out on the table initially will really, really help you, because there's nothing more painful than having basically just not having a good working relationship with the board and with your investors. There's nothing more painful than that.
Yeah, and just to add to that, I mean, it's a hard thing to reverse once they're on board. Once a partner's on board, and if you don't do the initial diligence on this piece, I think it's a really hard thing to reverse.
Before we move on, we have a question here from Reagan. She's wondering, in terms of the personal guarantees that you mentioned, does Lighter Capital require personal guarantees?
No, we don't. We do not require personal guarantees on our financings.
Great, thank you.
Do you want to take this? Yeah, sure. I'll start this conversation. So, from a fundraising profile, these are some of the questions, and we've already addressed them kind of at the top. But it's really about, okay, well, what stage of the company are you at, right? I mean, if you're at the very, very initial stages, and you're kind of, going after that, maybe that first round of equity financing, a seed. Maybe you've put a little bit of money in yourself. Maybe you've borrowed a little bit of money from your friends and family, and you're kind of really, really figuring out kind of what you've got and whether you've got something and whether there's a market potential for it. And at that stage, obviously, your options are a little bit limited. You're not going to get a loan from a bank. You're not going to be able to go to Lighter Capital for revenue-based financing, because you don't have any revenue at this point in time, right? So you're probably looking at, okay, can I get the interest of potential equity investors who will fund a company at this stage, or you just kind of shoestring, bootstrap things as much as possible and try to get some traction until you are able to get to that stage. But it's at different stages, and the profile that you have is going to drive kind of some of the options that you have. But it's, as you get a little bit further along, and as you start seeing what your potential market is, your addressable market is, and whether it's big enough, at some stage you're going to be able to look at this opportunity as something where, okay, with some investment and if we were to accelerate our efforts, we might be able to blow this thing out. We might be able to see that hockey stick in terms of revenue. And it's at that stage then you really need to be looking at the different options, both equity, and if you have enough revenue traction, then again, it's like talking with somebody like Lighter Capital to say, look, I've got this revenue traction, it's increasing, I need I need something that I can put in now, start capitalizing it on opportunity, and have something that can grow with me as we grow. That's really, really a great potential time to be doing this. I think the team, what you have at any point in time when you're first starting out, it may be just you. It may be just you and a co-founder. I think that's a great way to start, obviously, but you need to be thinking about, okay, how is the team going to expand? What are the next key hires that I have to have, and when do I need to hire those key people, and how do I fund those hires? Again, these are the considerations that you want to take into when you're trying to figure out, okay, where is the company right now, and what are my options in terms of being able to take this to the next stage.
Right, and we get into in the next slide, but I think this is a really good starting point with regards to sizing up your company as it relates to the capital markets and how you're entering it. For example, there's some cases where entrepreneurs just see a financing group and don't really understand what stage company they might finance. So for our purposes, say it's a later stage venture firm, and say you're pre-revenue, it's not really worthwhile going and reaching out to a late stage venture firm. So it's really, this is also just taking inventory of where you are, and in the next slide we kind of get into the various stages and what the options are, but it's always good to just take that internal inventory and understand sort of how you broadcast into the capital markets and what the availability of capital will be. So these funding paths this whole chart here is really instructive with regards to stage and sort of some of the breakout or key metrics to take into consideration, and the various audiences that will more than likely take consideration of your a possible investment in your company. So working left to right, the VC-backed is a more conventional approach to companies that are really addressing a very large market opportunity, and they have a product or service that's highly disruptive and requires it's very, I wouldn't necessarily say it's very capital intensive, but they need a lot of capital in order to launch a rocket ship, if you will, and achieve orbit. So these types of companies, just by profile, as I mentioned, are addressing large markets and have something disruptive in nature that has the potential to attain large market share and be a breakout company. So the usual route is starting with the bootstrapping and friends and family round, working up to angels, incubators, and crowdfunding. So these are some of the initial sources of capital. And the Series A starts to come in roughly, definitely post-revenue, and having that initial product market fit and starts to scale up. Tech banks start to get involved at this point. Once a more institutional VC is involved, they will look at the equity that's in the company as something to lever and add additional either lines of credits or additional types of debt to layer on top of that to enable growth. Once in a while you'll see corporate venture get involved. That's more of a, depending on who the corporate VC is and the type of opportunity, they usually invest more from a strategic standpoint as something that they can enable and sell into their core customers. And once you break out of that magical 5 million, if you will, in revenue, you start to see the Series B and Series C type players that are layering really large check sizes because what's happening here is the scaling of the companies getting more efficient. There's that product market fit, if you will. The cost of acquisitions are under control and becoming cheaper, and so it's definitely at that point it's really enabling fast, rapid market capture, and really, as I mentioned, the rocket ship's taking off, and they're hoping to achieve orbit either through an IPO or an acquisition by a large strategic buyer, if you will. And getting into the second column here, non-VCs type companies, we see quite a bit of these here at Lighter Capital. They're more likely really great technology companies with really great entrepreneurs. For some reason or another, either the founders are staying away from diluting themselves from the VC route, or their opportunities aren't large enough to take on the traditional venture capital route just by the size of the opportunity itself. It's too small. So they're largely underserved by VCs. They do start in the same fashion with bootstrapping and friends and family, and some angels might get involved. It might be more of a just something where the angels are comfortable and understand and can provide that advisory service, and incubators and crowdfunding is also an option here. Revenue-based financing plays well here in enabling a company to, as Sirk mentioned, hit certain milestones and really enable fast growth to hit that magical revenue line of 5 million, where all of a sudden the larger tech banks and, as you know, like the traditional banks really start to get comfortable the more mature the company is. So this is definitely the non-VC route. I would say that the companies here, as I mentioned, are targeting smaller markets, and the revenue-based financing is a good alternative here. The blended model kind of clearly, as mentioned, falls somewhere in between where it's a company that fits the VC type of profile, but they might be delaying the equity round, so they'll leverage revenue-based financing in order to hit certain milestones to drive the valuation piece higher and hit certain metrics. So by the time they get to a institutional pricing round, the company's more mature, and it then falls into the same traditional route as a VC-backed company. Well, they'll raise their A round. Sometimes here at Lighter Capital, we finance a company that has been in between the A and B round, and then they're well on their way to raising the larger rounds and launching or continuing to fuel the rocket ship at that point. So these are the three most common types of milestones that you'll find in the fundraising landscape.
Yeah, I think this is a great summary, Branden, of those three types of landscapes, and the blended one is a really great one for a lot of us who are going to be going the venture financing route. But there may come a time when it makes a whole lot more sense to take on either a little bit of debt, kind of to get those milestones met, because the difference in the valuation that you might get, depending on again the additional traction that you're able to achieve with the debt financing, could be huge, and it could be much more. It could cause great value to you as an entrepreneur and as a common shareholder and founder of the company.
Exactly. Yeah.
So, Branden, I know we're going to get into this more later, but we have a couple of questions. People would really like you to clarify what you mean by revenue-based financing. So, first of all, Tracy wants to know how it's different from angel funding, and Reese wants to know if you can just give a simple real-world example of what revenue-based financing actually looks like.
Certainly. Revenue-based financing is best applied to companies that are post-revenue, and more specifically, just how we practice it here at Lighter Capital. I know that there are some other firms out there that have different approaches, but we really view the recurring, predictable revenue streams of technology companies as the backable asset. And that's really driven by the type of business model. So you have subscription or perpetual licensing type business model companies where on a monthly basis, or it could be on an annual basis, contracts or customers continue to pay a recurring subscription fee to the company, and it's just sticky revenue. So as the company is scaling, that what we call the recurring or monthly recurring revenue or annual recurring revenue piece keeps increasing exponentially. And so we see that as really the asset that where revenue-based financing really can be of incredible value and non-dilutive. So when I say non-dilutive, we're not taking equity on the company. It is a debt structure, and usually it's a term note or whatever the debt structure might be. What you want to keep in mind is the repayment happens based on a royalty that's fixed to your revenue. So the way that we practice it here at Lighter Capital is for companies that we finance, we issue a term note of 5 years, and the repayment on the note happens on a monthly basis based on your revenue. We affix a royalty rate anywhere between 2 to 8%. So on a monthly basis, say 5% is attached to your revenue number. On a monthly basis, that 5% goes towards repaying the loan, the principal and the interest combined. So once we're satisfied on the note, we're off your balance sheet. But it's really it's a way to finance your company if you're really at the point where your growth model or the way that you're growing the company is really revenue driven. There's some companies out there where it's not a good fit. For example, ones where they just require heavy capital investment to acquire customers, but you're not monetizing on them yet. So these are for this type of financing really is built for companies that they're very revenue. Their growth model is really towards driving top-line growth, if you will, versus just like a more customer acquisition type play where it's you're looking for a big audience, and then eventually down the road you turn on the monetization. So those are some of the key features.
Yeah, and I know we're going to dive into it a little bit more, kind of in a couple more slides. But yeah, I think that's a great overview.
Thanks.
Thank you.
Just to kind of touch upon some of the different stages that you're at, and some of the different types of financings that are available to you. So we'll just kind of touch upon those in the next few slides here. Obviously, during your launch and your initial traction, this is basically where you're going to be going, right? You're going. I'm sorry. I'm one ahead of you. So on the ideation. So this is, at the early stages, you're putting a little bit of your own money into it. You may be trying to get a little bit of revenue coming in the door and bootstrapping yourself that way. A lot of people take out credit card loans or loans against their houses. Sometimes, but basically you're kind of self-funding, and you may bring a little bit of family and friends money into it, if you've got friends and family with the kind of capital to be able to invest in a startup venture. We obviously recommend caution when you're going down this route, just because obviously friends and family are a once-in-a-lifetime thing. Money is going to come and go, but make sure that everyone is on the same page with regards to expectations, the risk associated, and it's not just the risk of losing 10 or 20% of your capital, right, like you do with other types of investments. In this case, they're either going to get a nice return or they're going to lose 100% of their capital. So keep that in mind at this stage. But that's kind of what you're doing when you're first initially launching the company. In the next stage is kind of where you've launched the company, you're starting to get a little bit of traction, your hiring is increasing, your expenses are increasing, and hopefully your revenue is increasing. And at this stage, these are some of the things that are available to you, right? You've got a little bit of operating history, and so getting cash flow from things like, obviously getting cash flow from customers is key, and trying to maximize that and maximize the timing of it as well as the amount of it. But also start working with vendors, right? Start setting up accounts payable and have some of your vendors finance the cash flow of your company, while you're growing. Things like crowdfunding, going to incubators and accelerators and working with them and getting some cash in the door for some equity, with these early stage guys is definitely an option. And at this stage is probably when you start looking at revenue-based financing, right? I think we'll touch upon another slide where Branden talks about what that sweet spot is in terms of revenue. But if you are getting close to $1 million of run rate, then I think at this stage you definitely want to be looking at revenue-based financing as an option, and of course angel investors.
One thing that I'd add here, and even to the ideation slide, is the crowdfunding option. One thing that's really interesting to see, there are two approaches to crowdfunding. One is more to finance a product and get the initial money ahead of time, sort of like an advance. And you have like a concept of a product that you want to bring to market, and it's a really interesting way to get immediate market feedback, both on how you market yourself and get buy-in from early adopters to the product that you have. And if you actually meet your fundraising goals and you launch the product, then you basically have a business that starts that way. I think that's a really fascinating way to get some of that initial feedback and see if you have a viable product. And then the second piece, the crowdfunding, and I'd love to get your feedback here, Sirk, is with regards to some of the upside and some of the things to consider with regards to crowdfunding, with regards to say the number of investors that you could potentially bring through this channel, and have you seen anything with regards to financing in this manner, and what things the audience might want to consider?
Well, we certainly work with some companies that are crowdfunded. It's still obviously people are still trying to figure it out, right? The people are still trying to figure out the legalese of it, the equity piece of it. There's a lot of stuff to figure out. So I think initially, if it's at a really small stage, it's something that is much more viable. As it gets bigger and bigger and bigger, it gets a little bit more less wieldy. And there are absolutely considerations, legal considerations, equity considerations, the structure of your company, the way that your company is structured to take on equity. So all those things are consideration that probably kind of goes beyond this webinar. But yeah, just there's a lot of information out there in terms of crowdfunding. So if you're the kind of company where you think crowdfunding is an option for you, then we should research that and discuss that at a different time.
Yeah, great.
And I think at this stage, once you're starting to scale and once you're really growing, you got all those the previous financing options available, but now you're also taking a look at larger scale, whether they're VCs, you might be able to bring on strategic investors. So, you got the kind of revenue where you probably got some partnerships with some bigger companies, either from a revenue side or just from a partnership side in terms of the type of technology that you're providing. And this might be a key one for you if you can bring on strategic investors. They tend to be potentially really good partners and a really good source of funding for you. And obviously at this stage, you have probably the ability to go to more traditional banks for more traditional types of credit. And then, this is, I know this is a funny chart, but obviously, once you get, to the breakout and beyond, this is where you're probably going to be, you probably already have gone through a couple of rounds of equity financing, and you're pretty ready to blow it out at this stage, and you're not only looking at, financing for today, but also maybe a potential exit down the line, and at this point, you're probably going to have a lot of vested parties who are already involved, on the debt side and certainly on the equity side. And if you can get to this point, then obviously, you got a great future ahead of you here. Branden, did you want to talk about any of those kind of stages in more particular? I know this next slide is a really great one to just take a look at some of the equity versus debt considerations, but I'm not sure if there was anything else you wanted to add to
No,
this.
I think did a great job there. I think we covered everything with regards to the options there. So it's good to transition here to these considerations as you're thinking about taking on either equity or debt. And or revenue-based financing, if it's a good fit. Some key things to keep in mind here with regards to just starting left to right here with taking on bank or general debt from a traditional bank. This is more than likely this is where the personal guarantees come on. Any type of financing that a bank will provide. So that does mean perhaps your house or any sort of personal assets that will have to be collateralized. The added value from this channel is somewhat limited. I think it's safe to say that they'll provide some feedback on the investment and the opportunity, and they'll probably monitor the company's health. But they will put financial covenants more than likely, so they'll want to see certain ratios in the company. They'll like to see certain cash balances in the bank account, just from account management, if you will, standpoint. If you do qualify for bank debt, the upside is that it's non-dilutive for the most part. Some tech banks, for example, might ask for some warrant coverage. Which means that they'll ask for some equity upside to be included as part of the financing. More likely, there are fixed payments with regards to repaying the loan, and banks do move quite slowly. I think just the other day we heard from a potential client of ours that they explored an option with a more traditional bank, and the time to financing was going to be about 6 months. So that kind of falls back to that whole timeline perspective to raising capital. And if you do you may not have 6 months to wait and see if a bank will qualify you and get a financing in place. I'll just skip over revenue base because it's be more instructive to kind of jump to BC first, and then I'll describe our revenue based in context of these two bookends, if you will. So on the venture capital side, as we mentioned, it's a long-term partner. They will require more than likely board seats and voting rights, so they're going to sit alongside and help drive the strategic vision of the company. They do provide a lot of guidance and a lot of critical introductions to industry and can really be transformative when it comes to some of those key introductions and getting, say, some of your first big accounts in order to drive the scale of the company. It is going to be a fairly, if not highly dilutive event for the company, especially your first institutional rounds. The A and B rounds are some of the most expensive with regards to how much equity you'll have to give up in order to bring on an equity partner. The payment flexibility, I would say it's not necessarily realized initially, but you definitely, by the time an exit happens, you'll realize sort of like with that 40, say 50% of the company they give away, that's the cost, that's the realized cost for going this route. And the speed, it's kind of all over the place. I would say that it's fairly competitive out there for VCs to find really good companies, and so I would say that the financing turnaround time is probably one of the ways that they differentiate themselves and hopefully try to close a deal faster than the other firms. So I would say that at a rough range, it's roughly about that 3 to 6 months, but it's entirely possible to see a deal close fairly quickly. I mean, I was just reading about the Invisalign opportunity where Kleiner Perkins basically gave term sheets the first meeting, so it's all over the place. Now, how revenue-based finance relates to these two across this spectrum, if you will. So we have some of the features of venture capital and some of the features of bank debt, where, as I mentioned, the instrument is debt. But as opposed to bank, we don't require personal guarantees, and we don't put any financial covenants. The added value is medium, where I would say it's ad hoc depending on the company. We here at Lighter Capital make ourselves available to every one of our companies for advice, and if we can leverage any strategic introductions or roll our sleeves up and tackle any issues the company might be having, we certainly do that. We are a non-dilutive source of growth capital, so we don't take equity in the company, so you keep ownership of your company. The payments are variable in that the royalty repayment fluctuates with the revenue on a monthly basis, so on months where revenue is accelerating, then the payments accelerate or are higher, but we also share on any sort of downside in case the company experiences a pivot or there might be some seasonality, so the payments decelerate and are smaller. And we have a technology infrastructure here which enables us to fund the company in roughly about 6 weeks.
So we have a specific question.
One thing I'll add to this, and kind of getting back on the venture cap. Oh, no, that's okay, America. I was just going to say that Branden mentioned that deals are getting done a little bit quicker, and it is because very, very competitive, and obviously that kind of goes through its highs and lows. It is very, very competitive for investors to find good opportunities out there, and when they do, they will move quickly. But I always caution entrepreneurs against expecting that, right? You should be expecting things to take a long time. There will be a lot of tire kicking. It'll take time to get the interest of investors. Get a group together and do the financing. So I'd say 3 months is very, very quick. 6 months is probably more of what you should be planning for.
So there's a couple of specific questions here to this slide. First, Mark wants to know what kind of dilution are you looking at when it comes to venture capital? Do you have kind of a general range?
I think, obviously it depends on a lot of factors, but I think easily 15 to 20% on the low end, 25 to 35 on the high end per round. Again, kind of depends, and that's kind of round after round. It's like if you do 25 and 25, you haven't given up 50% of your company, because you give the first round of investors also get diluted in the second round when you give up 25%. But 20 to 25% is absolutely what the minimum you should be expecting. If you really made a lot of milestones, if you've really made a lot of progress, if you've got traction already, and you can make a case, why your company should be valued at a high enough rate, and you're raising low enough funds to still get you to hit your next set of milestones with the financing, you might be able to do with less. But 20 to 25%, is probably what you're looking at.
Yeah, and I would say that kind of reiterates back to that blended model of the financing path that we talked about, where we do see a percentage of the companies that we finance really benefit from revenue-based finance. So it really is driving that valuation, and we, I would say that it is in the hopes of not giving up, just at least giving them more to leverage in the negotiations on that valuation piece from a VC.
Great, thanks. And then also a specific question on the slide. Does revenue-based financing take a UCC filing?
It does. Yes, we do.
Okay.
Well, great. So this is related to Ladder Capital and in general revenue-based financing. And again, there are some other revenue-based firms out there, but this is more specific to how we approach it. So if you're considering working with us, these are just some of the high-level metrics and how we structure the financing. So our minimums, for example, or how we determine a loan amount is based on we take a look at your annualized revenue run rate and can lend up to a third of that amount. Now, we are capped at $1 million per company, so our check sizes are $50K up to $1 million. So for example, if you're at a 500K or 600K annualized company, we could lend up to 200K to get started. So there is, as I mentioned, there's no set interest rate. It really is variable, and it's really aligned with the company's performance. So as revenue increases, then the repayment accelerates, but at the same time, as revenue decreases, the repayment decelerates. So it's quite variable on a month-to-month basis. It is a 5-year note and what you'll find from as an alternative to venture equity, VCs or angels are looking for that 7 to 10x of their money. We're looking for a rough range of around 1.5 to say 2.5x return on our money, and the repayment on the loan happens on that on a monthly basis, and with that 2 to 8% range royalty of fixed fee revenue. And what we found with this range, anything above say 10% really starts to impact below the gross margin line. So we've modeled it out to where it sits nice and light on with regards to from a financing standpoint. It sits light enough to where it doesn't impact below the gross margin line and your operational side of things. And in lieu of any sort of equity upside that you do find, say, from a tech bank or any other type of debt financiers out there, we ask for a small cash side upside participation. And this is a percentage of the principal amount. And it really, the trigger point here is if the company is purchased or majority controlled is sold off within a 2-year tail after the note is satisfied. So some of the advantages here are that we sit completely off your capitalization table, so we keep that nice and clean with regards to if you take on equity partners, we are not on the cap table, and it's basically just a small cash success fee in the event that the company is purchased.
So we have a question here from Tracy. She wants to know, from a revenue perspective, what's the smallest company you funded and what's the largest?
Sure. So the earliest that we will consider and take a look at a company is a $15,000 a month revenue run rate. So ideally 3 months of 15K or above is where we'll start to take a look and get interested. We do like to see gross margins above 50%. And as far as, because we're capped at $1 million, you know, we have worked with companies that exhibit, you know, 10, maybe $12 million of revenue that qualified, certainly. At that point, we are competing for more traditional type of bank debt, and at times we'll win because of the value add that we do bring to the table. So I would say it is sort of like that. Call it 180K company all the way up to, say, a $12 million type of company.
Great. And I mean, in addition to revenue, are there other factors that you consider when you're deciding to fund a particular startup, or is it purely on revenue?
Well, certainly revenues clearly the key component of it. I mean, it is sector specific, so we are looking at the tech sector and sort of the business model. So we want to see the subscription or that recurring piece of revenue on a monthly or annual basis. It's good to have key management in place. Not too much debt on the books already. If there is debt, you know, we'll try to understand that a little bit. And I would say also, you know, we just want to see our capital is really earmarked towards growth, so we want to see the capital be deployed towards sales and marketing and product development initiatives. We don't finance working capital or any sort of factoring type arrangements. But yeah, I would say it's definitely growth capital to companies that have a high recurring revenue.
Okay, great. Thanks.
I'll just, I know we're already kind of running up on the hour here. So just as a final topic, you know, we talk about fundraising prep, right? What you should be doing as you're getting ready, and obviously all those things that you need to be thinking about in terms of what type of financing. That's what we've been discussing. But you know, when you get to this stage where you are going to start talking with people, these are the things that you need to really have down pat. You need to know your numbers. You need to know your historical. You need to know your projections. You need to understand what the assumptions are, and again, you know, what milestones you're trying to achieve, how much cash you need to raise to hit those milestones. You know, all those things are really, you know, what the uses of the cash is going to be. Every lender, every equity investors are going to want to know that. Obviously, you know, the pitch deck and other ancillary information data sheets that you're going to be providing. I think that lighter capital probably requires a little bit less than VCs, but you're going to want to have your, you know, executive summary. You're going to want to have a pitch deck, and if you have product, you obviously want to have a product demo. And then these other things, obviously, these are kind of, you know, I think they're probably obvious. You know, you need to activate your network. You need to really, really follow up and keep the momentum going. Fundraising is a very, very strenuous activity. You're going to be spending a lot of time, a lot of focus on it. It's going to be easy to just, you know, curtail it, especially when you're focusing on other things, but it's something that you need to keep the momentum going and keep it going. Otherwise, you know, it will lose momentum. Things like, you know, customer references, partner references. You know, if you have press, right? If you have press releases, or if there have been blogs or articles written about your company, all those things are obviously going to be important fillers that you want to be putting into your deck of information and data that you're providing to potential investors or lenders.
Great, thank you so much. So, we have a few questions. We don't have much time, but I wanted to at least get back to this one. It was from earlier when we were talking about that internal checklist that you should be doing when you're trying to decide the best, you know, financing path for you. Lavanya wanted to know, when you say, you know, it's really important to make sure there's a cultural alignment, but how do you see evidence of this? You know, before you jump in with someone and then you're stuck, how can you see if there's a good cultural alignment?
Well, it's got to be an interview process, right? A discussion. You're not going to be, it's not going to be a case where you're going to be making a presentation to an investor and they're going to say, okay, perfect, we're going to invest in this company and here's your term sheet. I think Branden mentioned Invisalign with KP, but that's that's pretty atypical. In most cases, you're going to be doing a presentation. They're going to be following up. You're going to be meeting with other partners. They're going to be asking you questions. You're going to be answering. You're going to get a feel for the types of pushing and prodding that they're doing. And you should be interviewing them too. You should be interviewing them for, hey, listen, in addition to the money that you're going to be providing, what else are you going to do for me? Tell me about your other portfolio companies and where there might be fits. Well, first of all, you should actually be doing your research and understanding where your company might fit with a potential investor. But as you're going through this process, you're going to get a gut feel. It's like dating. You're not going to find out everything you need to know on the first date, but as you go on the second date and the third date, you're going to find out a little bit more. You're going to delve a little bit more deeper into the personality, their communication style. You're going to get it. You're also going to, you should be talking with, if you get serious, you should be talking with, other portfolio companies, right? Ask for introductions to other CEOs of portfolio companies and talk to them and not only provide, hopefully sell yourself as a potential investment to those portfolio companies, but ask them, how is it working with this investor, the group, the individual VC that might be sitting on your board, when the time comes. There's lots of different ways to get the information, but you do need to get that information because you don't want to make that mistake and commit yourself to really a long-term relationship with this investor.
Great.
Yeah, I agree with that. I mean, I would say that from experience on a couple financings, especially with angels, what you'll find is, I mean, you clearly want to get a sense that they're working towards a win-win. So they want to enable you to do your job and drive the company, and they want to. You need to get a good sense or ask the types of questions, but both like on the upside, if the company's doing great, fine, but really start at part of that interview process, ask them, what happens if things go bad, for example. Like how do we handle this? And I mean, it could be an entire, perhaps, presentation we do down the road as far as things to consider, but it's definitely, there are a lot of considerations to have in place here.
Well, thank you guys so much.
300%.
Yeah, I think that's actually kind of a good wrap-up, right? We're talking about this. It's a process, right? Figuring out the best funding option for yourself, and I think that's part of the process. So I think we're pushed up against our time. If you've asked a question that has not been answered, we will follow up with you. And again, you can also send any additional questions by tweeting to us at EarlyGrowthFS with the hashtag alternative funding, and you'll get an email tomorrow with the deck and the recording so that you can review that tomorrow. And here's some information about how to get in touch with our presenters. We also have an upcoming webinar on Thursday, this Thursday, March 19th, called Startup Killers with Kevin Smith from Seed Change and Glenn McRae from Early Growth Financial Services. So we hope you'll be able to join us for that or one of our upcoming events. You can just check out our events page for more information or to register for this or any other upcoming webinar. So thank you so much, everyone, for attending. We hope you found this useful, and special thanks to Branden and Sirk for a great presentation. So thank you so much.
Thank you, everyone.
Thank you.